Hello and welcome to our 2025 TMT M&A and Investment Outlook. My name is Sean Murphy. I'm a corporate partner in our London office and I lead our technology practice in EMEA. I'm now joined by Kevin Friedman. Kevin is a partner in our Chicago office and is the head of our US corporate practice. What's your perspective on this? From a US perspective, what are you expecting to see during the rest of this year and then into 2026?
Thanks, Sean. AI acquisitions have definitely been the largest driver of M&A deal activity and will likely continue to be for the rest of this year. Public and private companies are seeking to acquire AI startups to enhance their products and services and gain a strategic advantage. I will add that this presents both opportunities and risks, and obviously the opportunities are great to build efficiencies and transform the customer experience for companies. But on the risk side, especially for public companies, there needs to be a really robust technical and legal diligence process in reviewing AI claims, which can be exaggerated, especially when you're dealing with earlier stage companies. And so the SEC, for example, is very focused on AI washing, which is the term they use for when companies exaggerate their claims about their use or ownership of AI to build investor attention. So this is something that is a growing area of concern. There's also a growing risk of consumer harm involving AI. So, doing diligence and mitigating risk of enforcement and civil litigation is an area of focus as well. I would say the second largest driver of TMT M&A in the U.S. has been media tech, and there have been some interesting developments there as media companies aim to scale and personalize digital content delivery. So, for example, there's an area called free ad-supported streaming television, which is getting a lot of attention, and it's a native cloud-based platform that enables viewers to personalize their viewing experience without paying a subscription fee, and it offers advertisers the ability to reach wider audiences. And I think we'll continue to see an interest in this area as a large component of media tech. Telecom M&A has been muted. Deal size has been quite large as the larger players are focused on scaling up their fiber to the home networks. And I think smaller deals will probably get more active as interest rates come down, and increasing pressure for exits will also make valuations more manageable for acquirers. So just overall, I would say strategic M&A has been and will continue to be the largest driver of TMT M&A. And as companies pursue talent, infrastructure, and AI capabilities, this trend will continue.
Thank you, Kevin. I'm going to turn now to Neely Agan. Neely is based in our Washington, D.C. office and is the head of our antitrust and competition practice in the US. Neely, what are the regulatory trends in the US and how are they impacting M&A and investment in the TMT sector?
Thanks, Sean. So there's been a lot of developments on the regulatory side in the US. To begin, there are new HSR rules that went into effect in February of this year that require more documents and information with an HSR filing. So unlike in the EU and other jurisdictions, historically, where a merger control filing requires a lot of upfront information and affirmative descriptions of the market, historically, the US HSR filing has been very limited, about a 10-page filing with minimal information that really contributes to the competitive analysis of the transaction. Starting in February of this year, though, those rules changed. We had the largest and most dramatic change in the HSR framework since it was introduced in the 1970s. The filing now, that initial filing, requires a lot more documents and information. So that has impacted all transactions, but I would say strategic ones in particular, because there's a lot more information that needs to be provided up front that you need to be careful about how you present it in thinking about how the regulators will actually review the transaction from a competition standpoint. So information like what the market is, who competes in the market, who the customer, who each of the parties' top customers are in the market, whether there's a vertical relationship between the parties, things like that are now required to be described in a narrative upfront in the initial filing. Historically, where documents that were prepared in connection with the transaction were the only ones that were required. Now, ordinary course documents like annual reports and periodic reports that are prepared internally for the CEO or the board that analyze competition, those documents now need to be provided in connection with the filing, in the initial filing. So the filing itself has a lot more useful information for the regulators up front, which has led to, I think, a more active review period during the initial 30-day waiting period. So all of this information is information that was historically requested by the agencies during that initial waiting period rather than in the filing itself up front. Now they're getting it in the filing itself, which has led to a quicker review of transactions, I think. The agencies have a better sense from the filing itself up front of what deals they should have questions about, and they can get into a more substantive discussion more quickly than in the past. So we've seen that, and I think we'll continue to see that. With the current US administration, the FTC and DOJ enforcement continues to be aggressive. I think there was a lot of questioning and unknowns of what antitrust enforcement would look like under this administration and whether we would see a retreat to a more traditional Republican view of transactions. But in a variety of sectors, including in tech and TMT, we're seeing continued aggressive enforcement under the current DOJ and FTC. But we're seeing different priorities. So while it's aggressive and we're seeing a lot of enforcement, it's prioritized maybe on different industries, different types of transactions. Some of the issues that they're focused on are different, but it continues to be a focus in the tech space. One thing we saw under the prior administration was settlements were really unlikely. The policy was against settlement when there was a transaction that raised competitive issues. So in particular with the DOJ, if you had a deal that had competitive issues and the agency was concerned and was planning to seek an enforcement action, historically you've been able to negotiate oftentimes a settlement that would remedy the agency's concerns. Under the prior administration, that really became an option that was hard to come by. Really, settlement was not considered an option. And if you had a transaction that raised competitive concerns, oftentimes parties were led to abandon the transaction or actually litigate. Now, what we're seeing under the current US administration is that settlement is again possible. So we're seeing an increase in strategic deals that perhaps wouldn't have gone forward under the prior administration, but with the possibility of a settlement, parties are feeling more comfortable, like they could proceed with the transaction and get clearance, perhaps with a partial divestiture or a limited remedy that will make the transaction still valuable and meaningful. Last, I would say, in particular in the tech space, is that the current FTC and DOJ continue to be focused on customer data and how a customer's data is used in a combined company post-transaction. So that has led to novel remedies and settlements such as restrictions on access to competitively sensitive information post-transaction. You know, historically, I think behavioral remedies, ones that are restrictions on the behavior of the entity as opposed to a structural remedy like a divestiture, have been less used. They're not preferred. And now I think we're seeing more of those behavioral remedies, and we've seen in the last 6 months some pretty innovative remedies that were allowed and used to allow a transaction to continue. And so in the tech space, where the acquisition and the accumulation of customer data has become more and more of an issue, I think more transactions are allowed to proceed with those remedies, allowing for the deal to go forward, but limitations on how that customer's data is used. So I think we'll continue to see and active deal making in the space, but continue to see active enforcement and settlements in the space as well.
Thank you, Neely. Very, very interesting. Hopefully this has been a helpful update on TMT, M&A and investment trends and activity. If you're interested in understanding similar trends elsewhere in the world, we'll be publishing a similar briefing on the Chinese market in the coming months, so please do look out for that on our website. In the meantime, thank you very much for joining us.